Please note disclaimers at end of show.
Welcome to Creating Wealth with Jason Hartman. During this program, Jason is going to tell you some really exciting things that you probably haven't thought of before, and a new slant on investing. Fresh new approaches to America's best investment that will enable you to create more wealth and happiness than you ever thought possible. Jason is a genuine, self-made multimillionaire who not only talks the talk, but walks the walk. He's been a successful investor for 20 years and currently owns properties in 11 states and 17 cities. This program will help you follow in Jason's footsteps on the road to financial freedom. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to the Creating Wealth Show number 137. This is Jason Hartman. Thanks for joining us. We have got a great show for you today. We've kind of moved some upcoming shows around because this topic is very topical. And basically what we're going to talk about today is how to bypass tough lending regulations, how to invest in income property using your IRA. We're going to expand on the very short segment we did a few shows back on Roth IRA conversion rules, which have changed, and that goes into effect in just, about 3 weeks here, 2 weeks actually, January 1st of 2010. This is a big tax giveaway, so it may or may not apply to you. If it does, you should be ready to take advantage of this. So that's why we wanted to kind of move this show up in the lineup, because it is very topical right now. Again, we have an interview here with Jennifer from Entrust, and I'll play that in just a few minutes for you. I want to tell you about some upcoming shows. We've got Lisa Broma, who is the author of a couple of investor books, most recently Wise Women Invest in Real Estate. And we've got Laurel Langmeyer. I'm sure you've heard her name. She's a big guru. And she is going to talk about making money now. Her latest book is all about how to just generate quick income. And simple stuff, but it works. So we'll continue along the investment, finance, and economic forecasting track, as well as the home-based business 4-hour work week, entrepreneurship track as well. And we'll be covering a lot of that great stuff on upcoming shows. We're trying to get about 3 shows a week out to you now because we have so many recorded that we have not published yet. I interviewed an attorney on asset protection recently. He did a great show. So just a lot of stuff coming up for you. Also, be sure to listen to our other shows, The Speed of Money, The Holistic Survival Show, Creating Wealth Video Show, okay? This is all free for you, and we've posted a lot of videos just recently to the Creating Wealth Video Show. So if you'd like more details on the various income property investment areas and a lot of the other concepts that we cover, completely different from this show, is the video show. So make sure you're watching the video show as well. And by the way, those are short. Those are usually 6 to 10 minutes long. They're much shorter shows on video. So take advantage of all of that and look forward to our new show coming up, our Jet Setter Travel Show, which we're about to launch. And let's go to the interview with Jennifer. Oh, one more thing, of course, upcoming events I got to tell you about. 23rd of January, Creating Wealth in Today's Economy Boot Camp. March next year, the Masters Weekend, and we've got a couple of conference calls and things we're going to be scheduling pretty soon here that we'll tell you about as well. So stay tuned for that. Here's the interview on investing in real estate with your IRA and how to get past the tough lending restrictions and regulations so that you can purchase more properties. If you've already reached your 4 property or 10 property limit, depending on which way you look at it, this show is also for you because we're going to talk about that. Anyway, here's the interview with Jennifer from Entrust.
If you thought making money on real estate was just for big spenders, well, you're in for a surprise. There are investments out there that require very little cash up front, yet have the potential for outstanding returns. Where are they? How do you get hooked up? Well, you're going to find out at the Jason Hartman Platinum Properties Investor Seminar. You're going to learn everything you ever wanted to know about investing in real estate, but we're too afraid to ask. You'll learn about the best areas for cash flow, how to make money with tax-free income, how appreciation works, and so much more. You can even see how to get back the taxes you've paid for the last 5 years just by investing in real estate. You need to attend the next Jason Hartman Platinum Properties Investment Seminar. You have to register soon because they're going to fill up fast. Visit jasonhartman.com.
It's my pleasure to welcome back to the show Jennifer Williams with Entrust Group, or the Entrust Group, I should say. And today we want to talk about the ever more desirable, and again, we have not covered this topic in depth before because over the years I haven't felt that this was as desirable as it is today, and you'll hear why. So what am I talking about? Self-directed IRAs. Self-directing your retirement plan so that you can invest in real estate. The stock market is probably getting close to a peak here. Many experts think we are due for another correction, and you know how ugly the last one was. So let's talk about having a self-directed account. Let's talk about being in control, which is commandment number 3, thou shalt maintain control. And when you maintain control of your personal finances, you don't leave yourself susceptible to the 3 major problems of outsourcing your investments to somebody else. What are those 3 things? I'll just remind you real quickly before we welcome Jennifer. They are, number 1, you might be investing with a crook. Number 2, you might be investing with an idiot. Number 3, assume they're honest, assume they're competent. The third problem is they take a huge management fee off the top for managing the deal. And that is why we love investing in income properties. Done properly, done on a nationwide basis so that you are diversified, because all real estate is local. You're buying properties that make sense the day you buy them. You're following our 10 commandments of successful investing, basically. And with that, the self-directed IRA plans have become much more desirable just recently. So that's why we are now interested in this topic. And Jennifer, we're glad you're here to talk to us about it today.
Thank you for having me, Jason.
My pleasure. What is it all about, and what can people do here?
Wonderful. So what I'll tell you about today is a little bit about Entrust, what it means to truly have a self-directed IRA account, what you can and cannot do in your IRA. We'll also talk a little bit about prohibited transactions, what to watch out for, as well as who you can't do business with, who are disqualified people in your IRA.
Okay, good.
Entrust will not give you financial or legal or investment advice, but we do these educational type events or broadcasts with you to educate the public and our clients on what you can and can't do in the IRA. So let me tell you a little bit about who Entrust is. Entrust is the oldest and largest provider of self-directed IRAs in the country. So we currently have over 27,000 clients and over $3 billion in our clients' assets. All of our clients' assets are all FDIC insured. So hopefully that'll give some of your listeners a little bit of a peace of mind at this point.
Now, just, Jennifer, tell us what that means. If they buy an income property in their account, that's not FDIC insured.
Correct.
Right.
It would only be their undirected funds, meaning once they have an account
funds
set
in the bank account.
Exactly.
So Entrust maintains a bank account for non-invested funds.
Exactly.
Okay.
So your actual IRA will hold undirected funds or uninvested funds. Any assets you purchase, such as real estate, once that leaves the IRA, obviously that's not going to be insured. But any cash or any funds that you leave in your IRA to pay for expenses, which we'll talk about in a little bit, all of that is FDIC insured.
So this is similar to when you have a brokerage account at Charles Schwab or whatever. You always have, I think, at least I do, a money market account there so that when you're trading in and out of positions, there has to be some place to catch the cash that's uninvested.
Similar.
So that part is FDIC insured.
Yes, it absolutely is. And along those same lines, and we'll talk about how the money should come in and out of the IRA, but along those same lines of the FDIC insurance, keep in mind since we are speaking specifically about real estate today, let's say you sell a property. So all of a sudden you're putting $400,000 or $500,000 into your IRA. You do not have to worry about that hitting that $250,000 FDIC insurance threshold. Entrust will immediately split up your funds into little sub-accounts. It's all within one IRA so that it's all FDIC insured. So you don't have to worry about how close are you to that $250,000 mark.
Okay, great. And the FDIC insurance limit, obviously, when the financial crisis occurred, went from $100,000 per vesting to $250,000 per vesting. The disclaimer I want to give you with that, folks, is that, yes, the FDIC may be insuring your account, and note that the FDIC is on the verge of bankruptcy or insolvency, I guess is a more proper word for that. They don't insure what the money will actually be worth when you get it back because they're going to print a lot of money to bail it out. But I digress. Go ahead, Jennifer.
So let's go ahead and talk about what it means to truly have a self-directed IRA. So the term self-direction is used really loosely these days. So many brokerage firms consider their accounts self-directed. So wherever your current
like
IRA...
stock brokerage firms.
Exactly. Yeah. So if you have a current account at one of those standard stock brokerage firms, and if you ask them if your IRA is self-directed, chances are they're going to tell you that it is, but not necessarily. The real test there is you ask them if you can hold real estate in your IRA with them, and that's where they're going to be like, oh, no, probably not. So what it comes down to with a true...
Far be it for a brokerage firm like Wall Street firm to mislead anybody. I can't imagine that, but...
Unintentionally, perhaps.
Here we go again, Jason, with your commentary. Okay.
So to have a true self-directed IRA account with someone like Entrust, they'll allow you to invest in anything except for a life insurance or a collectible. And we'll talk more about what that collectible means in just a few minutes. But basically, you want to think about your IRA as being almost like an umbrella. So all of your funds, in most cases, except for a Roth account, in most cases, all of your funds are going into your IRA on a pre-taxed basis, right? If you have a traditional account or a SEP account. And then all of your investments grow tax-deferred, right? Till you start pulling those funds out at retirement age.
And when you take distributions, now, this I got to just make a comment on, Jennifer. I think when Wall Street lobbied Congress to make all the laws that govern all of this stuff years ago, the sales pitch for a retirement account is, while you're in your earning years, put this money away pre-tax so that it grows pre-tax. And when you take distributions at 59 and a half, optionally, or you're forced to at 70, right?
70 and a half.
70 and a half. Then you'll be in a lower tax bracket, they say. But folks, I don't know about you listening, and I don't know about you, Jennifer, but I hope to be in a much wealthier position when I'm that age. And I certainly don't think with our Obamunist government we're going to see lower taxes, so lower tax rates, I should say.
Right.
Yeah.
Well, that's why if some people feel that way, sometimes a Roth is a good fit for them.
Right. But you know, just letting it grow, putting it into the account before it's taxed and having the power of it growing before the tax, even if the rate is higher in the future and your personal marginal rate is higher too, you can still win the game that
Absolutely.
way. So, yeah, pardon my sarcasm. I mean, there's
No.
a good opportunity.
Yeah, absolutely. So along those same lines, you're putting all the money into your retirement account on a pre-tax basis, and all of those investments are growing tax-deferred until you start pulling those funds out at retirement age. Along those same lines, all the rental income or any asset gain from those assets you hold in your IRA are going back into the IRA. Okay. So an example of that would be, let's say Jennifer Williams, bought in my IRA a condo, and then I'm renting that condo out. All that rental income from that condo is 100% going back into my retirement account. All of my tenants are just writing out a check in the name of my IRA, sending it into Entrust. Entrust is putting it in my IRA account. All of that's growing tax deferred. Along those same lines, any expenses I have associated with that asset. So it's a condo, let's say it needs a new water heater, new carpet, something like that.
Are paid out of the account.
Exactly. Yeah. All of those expenses come out of the account. Okay. So you just send in, as the owner of the property, my IRA, I would just send into Entrust an invoice for that new water heater, that carpet, and then Entrust cuts a check out of my IRA to pay those expenses.
Sure. Okay.
So you just want to keep in mind that it just needs to be a complete circle.
It's a separate entity.
It's a separate entity.
Arm's length is the rule. Is the word you need to know, the phrase you need to know.
Exactly. And in regards to real estate, the real key thing is to have your self-directed IRA set up before you find the property that you want to invest in. That way,
and I just set mine up with you last week, by the way. I've got to say that. I'm really excited about it.
So you're in the process of getting that funded and ready to go.
I'm looking at a property today, and we're just moving the money from that rotten stock brokerage.
It can be challenging, but we're helping you.
They've lost so much of it for me. I don't think I should trust them by giving them any more or letting them have the honor of holding the account. And by the way, when I'm talking to you folks, the Dow is up right now. I mean, the market's over 10,000 today. So, but still, it's nowhere near the 14,000 it used to be. So
along those same lines, you just, like I mentioned, you want to have your retirement account with Entrust opened first before you get your heart set on a property, meaning that once you find the property you want to make the offer on, from that very first stage, that first letter of intent or that first time you write that contract, you want to make sure you're doing the proper vesting. So it wouldn't be Jennifer Williams as a person, it's going to be Jennifer Williams IRA. So Entrust Administration, Inc., for benefit of Jen Williams IRA and my account number. Makes it really crisp and clear with the IRS that it's two separate entities purchasing that asset. Yeah, absolutely. Now, Jennifer, before you dig into this a little more, can you just sort of give the broad view here? What are the different types of accounts, of retirement accounts people can have? They hear all these acronyms, IRA, which means individual retirement account, SEP, 401k, KEO. What are the
other ones? I can't remember.
No, that's a really great question. Basically, you want to think about it as being two separate categories. More
Oh,
IRAs.
and of course, Roth. We'll talk about
Exactly.
that.
So you want to think about it as being two separate categories, IRAs versus qualified plans.
Okay.
So under that IRA umbrella, it would be a traditional IRA, a Roth IRA, a SEP IRA, simple, things like that.
Okay.
The traditional and the SEP and the simple, you're putting money in on a pre-taxed basis, like what we've been speaking about. The Roth is a little different. You're putting money in post-tax.
Right.
Then all that profit and gains is going tax deferred for life.
And we got to tell everybody, that's pretty exciting opportunity here, because you were on the show just for a couple of minutes previously, and there's a big opportunity coming up, which talk about it when you wish, but this is pretty exciting.
Yeah, absolutely. I'll touch on it just briefly if you
Okay,
like now.
sure.
So for 2010, there's going to be some Roth rule changes. Normally for a Roth, so this year and previous years, you have to make under a certain dollar amount in order to qualify and contribute to a Roth account. Those numbers vary every year, so they can be a little bit different. If you're married, you need to make under about $166,000 per year. And again, that number changes. So based on when someone's listening to this, they want to double check those figures.
Right.
If you're single, about $100,000 per year. And then you have to make under those thresholds in order to contribute to the Roth IRA. And if you do a traditional to a Roth conversion this year or in previous years, you can convert at any time, but then that's a taxable consequence. So when you do your taxes at the end of the year, whether that's the next April or the next October, you're having to pay taxes on that difference, that amount you converted. But for next year, they're doing two things, which is really, really exciting. They're taking away that income limit for 2010.
So if anybody actually still makes money, yeah, and again, being sarcastic, I know a lot of people do, because a lot of money is made in these down times, but there's no limit on the income to make them
Correct.
eligible for a Roth contribution?
Correct.
Okay.
So no matter how much someone makes next year for 2010,
Okay.
they're able to do a contribution to the Roth IRA, which also means they can do a traditional to a Roth conversion next year. So no matter if you make $250,000 next year, you're able to convert however much you would like out of your traditional IRA into your Roth IRA. Now, that's still a taxable consequence because you're going from pre-tax dollars to post-tax dollars.
Explain that a little bit.
Meaning that when you have a traditional account or that pre-taxed account, say you make $100,000 per year, you're putting in your $5,000 contribution to your traditional account, that pre-taxed account. Now, when you do your taxes, you're saying that you made basically $95,000 that year. Right? So you're getting that immediate benefit, and you've already paid taxes on those funds. Or you've not paid taxes on those funds, excuse me.
Yeah.
With the Roth or the post-tax dollars, you're in that same scenario making $100,000 per year. You put $5,000 into that Roth account or that post-tax account. You don't get that immediate benefit when you do your taxes. You're still saying you made $100,000.
Eventually, when you take distributions, you don't pay tax on the Roth.
Exactly. So for that Roth or that post-tax account, all that profit and gains, all that asset that you earned over the lifetime of that IRA, tax deferred for life. So at 59.5, when you start pulling out your funds, you never pay taxes on it because that initial contribution, you already paid taxes on.
Right. So the difference is, folks, is the traditional IRA, you're putting the money in pre-tax, letting it grow pre-tax. Hopefully it's growing in your investments. And with the Roth, you've paid taxes on it. You're depositing the money post-tax, but you get a lot of gratification later because when you eventually do pull it out, there's no tax.
There's no tax consequence at the end.
It's a different kind of thing.
Yeah,
Delayed gratification or now gratification,
Absolutely.
Yeah.
So when you do that conversion from the traditional to Roth conversion, it's a taxable event. You have to go ahead and pay the taxes on it at that time, getting it to that Roth status. But for next year, that second benefit is that they're allowing you to spread that tax consequence out over 2 years, meaning that you can spread out that tax consequence in 2011 and 2012 if you so choose. So it's just a really exciting thing, and if anyone wants to learn more about it, we can definitely put them in contact with CPAs and financial advisors to make sure it's the right fit for them.
Yeah, and we want to say to everybody, we don't give tax advice
Exactly.
or legal advice, but check out these concepts with your tax advisor. Now, Jennifer, have they ever done that type of thing before? I mean, the Roth is only, 10 years old or so, right?
Yes, they have not done that before, but there's talk about them, perhaps extending that income ceiling going away. There's talk about that, but again, definitely speak to your tax advisor, your CPA, or get in contact with one of us, and we'll put them in contact with someone who can advise them.
This is a pretty cool opportunity. All right.
Absolutely. So let's talk a little bit about why you would want to self-direct or what those benefits of self-direction are. We've already talked about what it means to have a truly self-directed account. Some of the reasons that people like to self-direct is it gives them control over their retirement account. Because let's face it, who's going to take better care of your money than you?
Good point. Commandment number 3. Yeah.
And self-direction gives you the freedom to invest in what you know and understand. So meaning if I'm a realtor, do you think I'm going to feel more comfortable buying real estate or stocks and bonds? Probably real estate. Or let's say I'm a mortgage broker. I'm probably going to feel really comfortable loaning money to someone and doing things like that instead of the stocks and bonds and mutual funds. So basically, it gives you the potential to invest in an area that you're already familiar with and something you're already really comfortable with. And something I think is the best is that by utilizing self-direction, it truly gives you a larger range of investments, so you're more diversified.
Mm-hmm. Yeah.
We would certainly never tell someone not to do stocks, bonds, and mutual funds. It just allows true self-direction.
But, okay.
I'm not allowed to.
Can you tell I'm bitter?
So basically, it allows you to invest in whatever your area of expertise is. So if you want to invest in real estate, you can. If you want to do notes, loans to people, private companies, you absolutely can do so. So when I spoke before, the IRS will not tell you what you can invest in. They're just going to tell you what you cannot invest in. So that would be everything we spoke about today, except for a life insurance or a collectible. So when we're speaking about a collectible, the code is talking about things such as an art collection, a wine collection, antique cars, rugs, things of that nature.
Right. And the reason being here is that the value, number one, is somewhat amorphous. Nobody really knows with a lot of these collectibles what the real value is. But number two is it's not going to be arm's length. So you can't hang beautiful art on the walls of your house and do that inside of your plan. Also, you can't really do the precious metals. Well, you sort of can. Here's what I want to just make a distinction about that, because I saw a commercial for a gold dealer today, and they were saying, ask about investing within your IRA and buying gold, but you can't hold the gold.
Correct.
And you know what, folks? I think that type of investing in the metals is nothing more than investing in fiat money. It's just, if you can't hold it, by the way, folks, I don't keep any of this stuff in my house, so don't try to rob me. But if you can't take possession of it, I don't like it as an investment, just personally.
Mm-hmm.
Okay?
And you're right.
Yeah.
Absolutely, with the gold, you can't hold on to that.
Right.
So it'd have to be
because it wouldn't
else.
be arm's length. It would violate that rule. Yeah.
Exactly. Which is actually a perfect timing. That's what we're going to lead into, is those prohibited transactions.
Okay.
Now, keep in mind, I think a key to understanding prohibited transactions is understanding who's disqualified to your IRA. So please know in just a moment, I'll go into more detail about who's disqualified to the IRA. But prohibited transactions are what the IRS says we cannot do in our retirement plans. So the key thing to remember is that you, nor anyone disqualified to you, can have any sort of present-day benefit from something going on in your IRA. So back to that condo scenario, if I had a condo in my IRA, I couldn't live in that condo. I couldn't vacation to it. I couldn't put my college-age kid into it, things like that.
Because it wouldn't be arm's length.
Exactly.
Yeah.
And perhaps even someone disqualified to me, which we'll speak about, would be getting some sort of present-day benefit from something going on in my IRA.
Right, and you're going to talk there about relatives and so forth. Okay.
I will. So in just a moment, I'll go into the disqualified people. So you can't sell, exchange, or lease any property between yourself and your IRA or anyone disqualified to you. So let's just say Jennifer Williams as a person owned a great condo in Hawaii. I couldn't vacation to it. Let's say I decide I want to sell it in a couple years. I'm getting really great rental income from that, and I want the tax benefit of that being in my IRA. Do you think I'd be able to just sell that to my IRA or put it into my IRA?
No.
No. Absolutely not.
Not arm's length, yeah.
Exactly. You also can't lend money or extend credit between yourself and your IRA or anyone disqualified to that. So an example of that would be, let's say I have a daughter who was recently laid off from work and she really wants to borrow some money. I wouldn't be able to loan her money out of my IRA. I could certainly loan her money as an individual, but not from my retirement plan. You also can't provide goods, services, or facilities between yourself and your IRA or anyone disqualified to that. So an example of that would be, let's say I had a piece of raw land that needed to be excavated, and my son had an excavating company.
How convenient.
It would be. I could not hire his company to excavate that property for me. He couldn't do it for free, and he couldn't charge me fair market value for that either. Right.
See, folks, I think generally the rule of thumb here, and you're thinking about this disqualification stuff, is if the government does it, or if Wall Street does it, you can't do it.
Oh, nice. Yes.
I'm just grinding that axe. Yeah.
You also can't use the income or assets in your IRA for personal gain. So
like if the government or Wall Street does it, you can't do it. Sure.
You can say it, I can't say it. So an example of that would be, let's say I'm a realtor again. So I want to go out and find that piece of real estate that I want to hold in my IRA. I can absolutely do so as the realtor. I can write the contract. I can do that all day long. I just can't take the commission on it.
Oh, yeah.
Because I'd get I'd get a present day benefit from something going on in my IRA.
Right.
So like I mentioned, a real critical aspect in determining whether a transaction is prohibited or not is understanding that disqualified person to you. So let's talk a little bit about that. You are disqualified to your IRA as well as your spouse.
Okay.
And then you want to picture your family tree. It's your direct ascendants and descendants and their spouses. So that would be your parents, your grandparents, their spouses, your children and grandchildren and their spouses.
Okay.
So it's that real arm's length distance that we're
But your
referring
cousin or your uncle, what about those?
to. So brothers and sisters, aunts and uncles, for the most part, are fine according to the code. If you read the code,
brothers and sisters, I'm surprised.
Brothers and sisters are fine. We tend to really treat that as a gray area, though.
I would too. Yeah.
Personally, would I do it? Probably not. But as far as the code is truly written, brothers and sisters, aunts and uncle are fine. But definitely you want to analyze that. Perhaps, speak to Entrust about it first. Maybe speak to an attorney about it first, just to make sure that you're not connected on too many levels.
Right. For example, if you have a terrible relationship with your brother or sister, then it might be okay.
Right.
Because you could justify that. I'm kidding.
Right. Well, perhaps maybe do you live with that sibling still, or
Well,
do you work
that
together?
would probably be bad. Yeah.
Right. If you're connected on too many levels, do you have power of attorney over some aspect of an uncle or an aunt's life, then the IRS could argue that you might have undue influence over that person. So
the point is, do your business with outside strangers
just
and
keep arm's
it clean.
length distance.
Yeah,
Absolutely. Absolutely.
Thank you for listening to the Creating Wealth Show. This is Jason Hartman, your host, and we appreciate you following the show. We have many, many episodes, hundreds of episodes, and some of the older episodes have been archived and placed in our members section, and that applies to this one. So we include a sample that's about 25 minutes long, and then for the rest of the show, you can go to our members section at jasonhartman.com. Many of the other shows are still in their full-length, complete version. However, some of the shows, like this one, are in our members section where you can hear the show in its entirety. And again, you just need to go to jasonhartman.com and you can get the full show there in the members section, plus a whole bunch of other great members benefits and resources, whether it be documents, forms, contracts, articles, other video and audio content. Just a great resource. So be sure to join as a member at jasonhartman.com. And thanks again for listening to the Creating Wealth Show.
This show is produced by the Hartman Media Company, all rights reserved. For distribution or publication rights and media interviews, please visit www.hartmanmedia.com or email media@hartmanmedia.com. Nothing on this show should be considered specific personal or professional advice. Please consult an appropriate tax, legal, real estate, or business professional for individualized advice. Opinions of guests are their own, and the host is acting on behalf of Platinum Properties Investor Network, Inc. exclusively.